All right, everybody. I invite you all to take your seats so that we can get started with our next panel here today. And for those that were here in my initial intro this morning of the Allocator Roundtable, we actually wanted to take that a step further and invite one of the funds that participated on that Allocator Roundtable to host their own panel with some of the funds that they've actually allocated to give you folks an example of not just their criteria, but in the flesh, actually what they're looking at and talking through some of the strategies there. So with that, I'd like to introduce for the MicroCap Allocator panel, Doug Porter from Acuitas Investments.
Robert, thank you. Speaking on behalf of Acuitas Investments and the 7 people that make up our team, just want to thank you for being able to present here at the Planet MicroCap. We appreciate the opportunity and actually look forward to meeting people. So just real quick, and I know Chris talked about it in the our first presentation, but Acuitas, we are a small and micro-cap investment firm. We're a multi-manager based out of Seattle, Washington, over $900 million in assets. Specifically, we allocate to micro-cap strategies in and out of the U.S., so across emerging markets, developed markets, regions. So, and as part of that, we specialize in trying to find really talented managers early on, those that are undiscovered money managers, and ultimately build portfolios primarily for institutions of those early stage managers. And why do we do that? And just a reminder to everybody, those managers are often long on experience and focus and short on attention and institutional knowledge. And that's, frankly, a really great place to be. And our research suggests that's usually a better outcome for clients when you're not focused on just lots of other things outside of your investment work. So with that, I'd like to introduce the panel. First is Colin Kelly. Colin, raise your hand. Hey, guys. Colin is the partner, director of research, and co-portfolio manager of Signia Capital, a small and micro-cap boutique based in Spokane, Washington. They are about $100 million in assets. An interesting fact about Colin, outside of work, he's quite the golfer and actually even a great rower. So it's good people.
Well, I mean, I made the boat, so I mean, they didn't throw me out of the boat, so yeah, I have rowed, yeah.
Awesome. Travis Prentice, EAM Investors. Travis is the CEO, CIO of EAM, which he co-founded in 2007. Great time to set up an investment firm, as you probably, Travis can tell the stories. But EAM now is a $2.5 billion boutique based out of Southern California and also with locations up in Spokane, Washington as well. But they now manage micro-cap strategies and small-cap strategies across the developed and emerging markets region, so including U.S., non-U.S., and global. Interesting fact about Travis, he's the only member of the panel who swam across the English Channel. So,
oh, thanks.
yeah.
It's just a tolerance for pain, just like being a micro-cap investor sometimes.
Yeah.
It's all that matters.
Well worth it. Yeah.
Your propensity to take pain.
James Peterson, Deputy Chief Investment Officer of GlobeFlex. It is a quantitative firm with $4.6 billion in assets based in San Diego, California. They manage small microcap strategies as well as part of their business across the developed and emerging markets. And outside of managing small and microcap portfolios, James manages the hectic, volatile schedule of his 2 twin teenage daughters.
Now that's more chaotic than MicroCap.
And our last panel member, Dave Baeckelandt, he's the head of client relations at SuMi Trust Asset Management. SuMi Trust is the U.S. arm of Sumitomo Mitsui Trust Asset Management. He represents a team that manages a Japanese microcap strategy. Dave is our resident man of many talents. He is an author, a mechanic, salesman, a collector of antiques, just generally a really smart, capable person, and so we're happy to have him here on the panel.
Thank you, Doug.
Yeah. So I want to kick it off and maybe just jump right in here. And I will say this: we want to have a lot of time for questions. So we're hoping to make this interactive. Our goal is not to speak at you. Our goal is to make this something that's a little bit more informative. So I'll just go right to the chase here. To those aspiring investment entrepreneurs or those taking a long look at their investment firm, what are some recommendations you have for building a sustainable, client-centric investment business? Do's and don'ts are welcome. Travis, you want to take the first swing at this?
Oh, yeah, well, thanks for that. Yeah, maybe don't do active equities, maybe do private equity would be, no, I'm just joking. I think one of the things that I've learned over the years, and I think I'm in my 27th year of managing microcap strategies and other long-only active strategies, is just persistence. And it's going to be way harder than you ever imagined, but also more rewarding than you've ever imagined to start your own firm and to follow that pursuit. So I think one of my mentors said, the highs are higher and the lows are lower, and that's for sure. So I think being that everything's cyclical, so persistence is really the only thing that I think that matters. Staying in the game long enough to be successful. So I don't know if I answered your question, but that's what I'm going
great
with.
Answer. Yeah. Colin, love to hear from you
Sure.
about your
I'll just chime
experience.
in. So as Doug mentioned, we run about 90 million in small and microcap, and then we just launched a small cap strategy. My business partner, Rich Bevan, and I actually bought out the firm in September of 2020. And so to Doug's question, the reason we were able to buy out the firm in September of 2020, this package was put together in the middle of the pandemic. It was because of our culture and our working history together. I actually interned with Rich back in 2003. Rich and I had worked together for the last 13 or 14 years, and COVID created the opportunity where we had a managing partner who had controlling interest, who wanted to go do something else. And so I think Chris may have mentioned or the earlier panel about entrepreneurship, and I think that's really, that's a key component to if you want to succeed in this business, is you need to be entrepreneurial. We are a two-person firm, but we have outsourced compliance, we have outsourced marketing, we have an outsourced trade desk. We partner with other individuals to leverage our expertise, but at the end of the day, we want to focus on research and marketing our product, essentially. And so I guess a long-winded way to answer Doug's question is to say, if you're partnering with somebody, make sure it's somebody that you get along with, that you're partnering. The good times are really easy. The tough times are when the rubber meets the road. And so the fact that we were formed in the middle of the pandemic, I think it probably, hopefully doesn't get much tougher than that. Yeah.
Or global financial crisis.
Yeah, I mean, they're 1 and 2 right there. Right? Yeah, that's a good one.
Dave, you've worked at top-notch consulting firms. Love to hear your perspective on what you've seen over the years.
In terms of what works, and yes. So great question, Doug. I would say, one, perseverance definitely is a factor. The other thing is listening to clients. Clients will tell you what you need to do. And I mean, it sounds pretty self-evident, but clients will say, why don't you do this? Why don't you do that? Why haven't you done this? And oftentimes they're looking at your competitors and benchmarking you against them. So if you've got your ears open and you can listen more than speak, then oftentimes that helps a great deal.
That's great.
Yeah. Can I just add on to
Please,
that one thing? And I think if I were to look back at our history, I think that's one of the bigger mistakes that we've made as an investment management firm, is to not think about, because investment management business is a competitive game. You tend to be insular. You think about your performance versus others, but really it's about what's in it for the client at the end of the day. So it's not really about you. It's about who's on the other side of the table and what benefit, what utility you're providing them. And I think that's one of the lessons that we've learned, that changing that perception a bit, I think has led to definitely more successful and prosperous relationships for the business and for our clients. So I would echo that for sure.
James, question for you.
Yeah, I'll take it maybe a slightly different direction. All these are incredibly good points, but I think don't even bother starting unless you have a good philosophy and process and have that hammered out, nailed down, because everything you're going to do from there is based on that. So it's your raising of capital based on your philosophy process. It's your communication in good times, and more importantly, bad times, that links back to that philosophy process and what you communicated and sold people on. So keeping that consistent through time, I think, is incredibly important. And kind of echoing, I think, what Travis said initially, I remember the first quarter, it was the second quarter I was running money, and I had a relatively small amount in my firm, and I had a horrible quarter, underperformed by like 2%, and I was freaking out. I was like, this is the end of the world, and it was great to have a mentor come around and say, look, this is this is nothing. Just wait, because the lows are lower, the highs are higher, and it ended up obviously working out just fine. So stick with it, persistence, and also believe in what you started.
Can I just say one more thing about
Yeah,
that, Doug?
absolutely.
I think when we say persistence, I think it's another way of politely saying that it's going to take longer than everybody thinks. And I think that, I don't know, it's true for everybody that I talk to within our industry, and it's the same for us, is that, when you're talking to allocators and you're talking to potential investors, to Travis's point about what's in it for them, they need to get comfortable with who you are and what your process is and, what the environment is like. And so I think as I've gotten older, I've learned to understand that they need to see how we operate in different types of environments, that previous data is helpful, but getting to watch us and talk to us and understand our thought process, that's really helpful. So we take every opportunity to talk to whoever wants to talk to us, because that's an opportunity for them to learn about what we're doing and how we're thinking, and ultimately we know that that is going to help them make their decision. So persistence just means you got to keep after it, and it's going to take longer. Yeah.
Related question. Fees are coming down. That has been a long trend.
Yes.
Boutique firms with limited resources, limited time. How do you do more with less? Or what things are you thinking about in terms of managing your business and ultimately managing your sanity?
Yeah, I can go. I mean, I think one of the things that's happened over the last 3 decades that I think is inescapable is the amount of choice investors have now. And you can express your views on the market or whatever in so many different ways. And the other thing that's happened is there's massive asset managers with tremendous scale, right? And so what does that mean is effectively we're all competing against zero. In essence, right? Vanguard, right? It's zero. It might go negative. So that's a reality that you have to accept, because I don't think it's going to reverse. So what that means is that if you're going to focus on microcap, because it's by definition smaller, so not as much capacity, you really got to think about scale in your business in terms of. So we used to just do micro and small, but we always kind of say now that we got to do mid so that we can continue to do micro, because fees are coming down. That's just the reality. And I think what that does, though, is if you embrace that reality, I think it creates opportunity. So for us, we're a little bit maybe better positioned because we're largely systematic, so we can leverage technology a bit to do more with essentially less. And you would think technology costs would come down over time. We haven't experienced that yet, but we're hopeful.
Yeah.
It's scale. It matters.
Yeah, I would say leveraging technology. We're, I guess, a two-person shop, and then we outsource, as I mentioned, compliance. If I was just starting up a firm, I would look for outsourced compliance, because compliance is incredibly important. You can't get in the door and have a conversation without having that buttoned up. But in the same respect, you don't want to spend your entire week focused on compliance and taking your eye off the portfolio. And there are plenty of outsourced compliance solutions nowadays that I think people should look into. On the trading side, I mentioned that we do outsourced trading. The prior iteration of Signia, we had an in-house trader. Our outsourced trading, from our perspective, has it's lessened our burden. It's basically a person that is an extension of our firm. We've got better execution, and the data shows that. It's in our trade data and performance. So I think the great news is you can leverage all of the technology and all the outsourced capabilities, whereas 20, 30 years ago, that was much more difficult. So fees coming down, I think, just means you have to be a little bit more creative about how you structure the firm. It's not going to be a 10-person firm out the door, to start.
Yeah, I'll jump in too. So we're a little more quantitative, more systematic in nature. So we have heavily leveraged technology and systems and data providers. A big part of my role as director of research as well is to keep things focused. So we're not providing ivory tower research. We don't have 90 PhDs on staff. We don't need them. There's no reason to have that as a small boutique. But what we do have are very, very focused, alpha-driven individuals that, cut out all the fluff. We don't publish a lot. We're just focused on driving alpha for our clients. So I think that focus, narrowing it down, and again, what's important, almost going back to the first point I had, what's your philosophy, what's your process, is everything pointed towards that? If it's not pointed towards that, it's excess, get rid of it. I think 20 years ago, firms didn't have to do that. But nowadays, it's incredibly important as a boutique.
And I'll echo what everyone
Yeah.
just said, which is flexibility and frugality. I mean, fee compression is a problem, and it's as everyone's pointed out, it's here to stay. For us, maybe the biggest issue has been focusing on what we don't need. So there are so many things that have crept into processes, our attitude, and just our regular day-to-day. And you cut some of those out. Conferences, for example. This is a great conference. I'm glad I'm here. And but there's other conferences we've gone to, and really the ROI just wasn't there. So.
Thank you.
Can I say one more thing?
Yeah.
I think what matters in this industry now that's kind of in a secular decline, if you really kind of look at it, is you got to have something different to say.
Yeah.
I think differentiation in your philosophy and process is hugely important, because you can go out on eVestment Alliance or whatever, and if you look up MicroCap, MicroCap's a little different because there's not many, but small cap, you can get like 250 strategies, right? And so you just got to be able to have something unique and different to offer, because differentiation, and I think in this business, is something it's super important that not a lot of people talk about.
Switching gears, obviously across the panel here, we have some more systematic investors. We have some more called fundamental investors. So there's some different perspectives. With 25 to 40% of the assets managed, depending upon the region, assets managed that are quantitatively driven. I'm quite curious the perspectives. Which is better, quantitative, systematic, or fundamental?
I mean, I'll jump in on this. So I started off my career in more of a fundamental role and moved into more of a quantitative role. And the whole point behind what we found was just you could scale it up. So you're building the same models, looking at the same measures. They're all fundamentally based. There are quants that do things differently that aren't fundamentally based, so I'm separating from that group. And again, what we're looking for is predictive fundamentals. So a lot of people will look at quantitative measures and just say, does this factor lead to performance in stocks, and is it predictive? There's a step in between which a lot of people forget about, and that's, is that predictive of upside surprise, of multiple expansion, of sustainable quality? And if you can bridge that gap, then all of a sudden your underpinning of your quantitative way of doing things is kind of locked in. It's not spurious correlation. It's not, you're not pointing just performance in some factor, which is somewhat arbitrary in our viewpoint. So I think there's a lot of differentiation in terms of those two worlds, and I think the world has also come very much together in a lot of ways. I'm not going to speak for the rest of the group up here, but I mean, quantamental and like what was fundamental, and used to call up the analysts literally on the phone and get the bull and the bear and and it was, that all can be automated in a lot of ways nowadays. So that's my take on it. Yeah.
So as a fundamental value shop, whenever our stocks are down, we just blame the quants. So we just say it's the algo's gone crazy. That's half joking, half serious. But there's a place for both. I mean, I'm not naive to say that fundamental value is the only way to go about investing. There's growth, there's momentum. There are multiple ways to invest. I think to your point on quantamental is that as a fundamental shop, we actually are putting more quant into our research process to help accelerate it. So we utilize alpha theory. This is a plug for alpha theory, I guess, then, which is, alpha theory uploads our position holdings. We put our fundamental data in there as well as our qualitative data. So we pride ourselves on doing management calls. There's fantastic access to management within the microcap space. We're talking to the CEO or the CFO, and all of that is fed into our alpha theory database. And so we rank all the management teams. We rank our catalyst. That's another kind of softer, but we try to quantify that. And what it does is it allows us to have our portfolio real time with our highest convictions. And so we don't utilize that. That's not how we implement it. But for us at Signia, we utilize that as a talking point to say, hey, we're underweight this name by 200 basis points relative to what our data says. So we should take a look at this. We either have the inputs are wrong, or we need to take this name up. So I think those worlds are actually converging, and it's a good thing. It's made our process better, and we've turned over more names as a result.
Another question for you. FTSE Global Microcap Index has over 9,000 securities. We have a global perspective on this panel. I'm curious to hear, as an allocator, what should I be thinking about in terms of regions of opportunity? How should I be thinking about microcap if I want to get the biggest bang for the buck?
Well, I'm going to jump in, Doug, and I'm biased, of course, because all we do is Japanese microcaps, but definitely believe that the opportunity is right in Japan. There's, out of the roughly 4,000 Japanese stocks that are publicly traded, roughly 2,800 of them have a market cap below 300 million. And out of those 2,800, only a small percentage are actively covered by the sell side, truly a small percentage. And most of that coverage is in Japanese, and most of that coverage comes without any strong positions. So in other words, it's truly a fundamental bottom-up market, number one, and number two, the opportunities for real price discovery, especially when the rest of the world is able to start investing in Japan and Japanese microcaps, I think will be huge. So.
Travis, didn't you write a white paper on this recently? Yeah.
And Travis just wrote a white paper on Japan, so that's even better.
I can speak to Japan a little bit, but I just want to come back to the global perspective. I think it's like the fundamental law of active management, right? It's the breadth of opportunity times the skill. So I think if you look at it from a relative perspective, where's the most opportunity to add value? I mean, with an index of 9,000, you can create a lot of different portfolios that act much differently than the underlying index. So I think from an active management perspective, the global opportunity set in micro is tremendous. And I think if you apply some skill in a process, again, some kind of consistency and repeatability of process, it doesn't have to be purely quantitative, but some kind of systematic approach to discovering the ideas that you want to do work on in the first place. If you apply that to a much broader opportunity set, I think your probability of creating value-added returns over time is greater. So I would say in anything you look at, the broader the opportunity set, the better the option of adding value from active management.
Yeah, I'll jump in too. So I think Japan, I totally agree with the Japan idea. And there might be a structural change going on there. And I think that's even more exciting because it has been a relative alpha loser for 20 years. Just being fair. So
a little bit more than 20.
Yeah,
I'd say 40.
Nice. All right, nice and fair. So I think there might be something going on there, and I think we all kind of agree on that. But I also think just even the U.S., you're dealing with an environment where we'll call it the field, or in Vegas, right? So you bet on numbers or you play the field, but playing the field has just not worked. And I think that we all can appreciate that, mega cap tech and very narrow parts of the market have gotten really all the capital and all the flows and all the interest and frankly all the performance. And meanwhile, the rest of us, either value growth or focus on small cap or micro, has kind of been left behind. So there seems to be, we've done some studies on this, and there's probably about, I'm not going to quantify, but there's a large hole that is due to come back just to get us back to average. So if anything, I think micro cap, small cap, broadly is a great place to be. The efficiencies of a bigger universe, yes. I mean, you want that as much as possible. Emerging markets are also kind of new. EM small cap is new. EM microcap doesn't even really exist on the, the 6 quadrant consultant, whatever. I mean, EM barely exists, but so there's no allocation there. There's no one doing it. That might be an actual interesting opportunity as well. So I'm in for everything microcap.
Yeah.
Yeah, it's a bit of a paradox though, isn't it? Because no one's paying attention to it, which means if you are seeking value-added returns, it's probably the place to go, but it's like a chicken and egg phenomenon. Yeah. It's like you need the capital flows.
Yeah, you don't want the flows because then it goes away, but then you want the flows to,
I want to pause there. Love to open it up for some questions. Please feel free to ask anything that's on your mind.
I just wondered if you could go down another layer to the kinds of specific things that you're investing in right now. The hot picks.
Well, please disclose. Please disclose.
Yeah, I'll take myself right off the table here. There's, and I said this earlier, but there are 2 people that I don't go back on my word with. That's my wife and my compliance officer. So, I can't talk about names, but we are invested. Industrials seem to be a great area in general. So we see a lot of value in the industrial segments. We're underweight regional banks. That's obviously a huge part of U.S. microcap is the regional banks. That's kind of where that lives. The other side, biotech. So the non-earning biotechs. You can always buy a bucket of those, and they've crushed it this year. But we're also underweight that. It just seems out of place from our style and our perspective. But others might have a different feeling.
Well, I'm happy to jump in on the Japanese side. I'm not allowed, just as our colleagues are here, I'm not allowed to speak about specific names, but I can give you directionally, and maybe we'll get some confirmation or correction. Some of the sectors that we find really attractive and where we're seeing some interesting things. For example, most of these tie into maybe not specific Japanese developments, but for whatever reason they're starting there first. For example, hospice is logical, but custom meals for hospice patients that are dietetically as well as medically sound is kind of a trend in Japan. Others are labor-saving issues that tie into, well, I don't want to give it away, but and some others are names that would tie into education, which the Japanese are very keen on, and not just during their formative years, but well into adulthood. So I'll stop there without getting in trouble.
Yeah, I can speak broadly on trend because that's pretty much what we do. We look for momentum or trend. And so what we're seeing globally and in the US as well is a massive accelerating of trend and brand new trend in everything AI, but outside of NVIDIA's of the world. So you mentioned industrials, and a lot of the strength we're seeing in industrials is in the massive infrastructure spend necessary to do what all the metas of the world want to do with AI, right? So data centers, thinking about even HVAC companies, right? Something has to cool these large data centers. So you're seeing this broad, not only the Infrastructure Act in the US, but the build out of AI. And we know from Meta's quarter that they're spending a tremendous amount of money, tremendous amount of capital. And I think that's really fundamentally good for small and microcap globally, because a lot of the beneficiaries of that spend will be kind of in mundane industries like utilities. They'll probably become growth companies in the future because of just the massive demand on electricity that's coming. It's already here, but it's coming. But even cement, like general industrial type things are now increasingly becoming AI plays. Mm-hmm. And I think that's fundamentally good for small and microcap globally. So I do think this broadening out of the market, specifically there, is good for small and micro.
Yeah, and I would just say, sorry, we publish at signiacapital.com. You can look up our latest investor presentation and quarterly newsletter, so we do have information on individual names. But I would say on Travis's side that being a fundamental value shop, we run into a lot of industrials, metal bending companies, cement companies, shipping companies. Shipping companies necessarily aren't AI plays, but they're really interesting right now because the boom that we saw post-COVID in container rates, which everybody remembers, we saw the ports being backed up, and then my kids were like, where is everything? That has now caused basically a supply of container ships to be ordered, and now the shipyards are filled with container ship orders. So what that means is that other ship builders, you call it crude tankers, if anybody that's looking to build a ship, they're not going to have access for the next 3 to 4 years from what we've seen through our channel checks and dialogues with management. Not to mention the cost of building a new ship is significantly increased. So this shipping is obviously a commodity, and so when you have tight supply or tight new supply, that's usually pretty supportive for day rates, and there are a lot of very interesting shipping companies. I think you need to be aware of the structures of these companies. Some of them are just family-run businesses that are publicly traded, but we've got one in particular that we own that we like the structure. We like their contract and spot kind of mix, and is a nice dividend payer as well. So the great news is that there's always something to look at in small and microcap space. So, yeah.
I was curious a little bit more about on the kind of on the international side, like with Japanese stocks or that. of going through, how do you get comfortable with the cultural differences or just understanding that what's going on, the boots on the ground, being in the U.S.?
So I'll start. For our team that manages Japanese equities and Japanese microcaps, they're all Japanese. So they're all native speakers. They're all based in Tokyo. And so all of that is not a leap for them, but it may be a leap for others.
Yeah, so I've never been in Japan, but we've done pretty well in Japan over the years. And because I think there's predictive alpha in objective evidence and objective data throughout the world. And so we rely more on objective signals rather than kind of boots on the ground. And it's worked quite well for us, even in things like biotech, for example. So I think what we found is globally, there are alpha sources, and we happen to think momentum's one of the best, and that's why we focus on it. And so we take all of the power of our experience and technology to really focus in on the factors that are at least predictive at some probability level of future outperformance. And so we come at it from a purely objective perspective, because alpha sources tend to be, at least for momentum, they tend to be global. They work everywhere. In fact, we did a paper on that too.
Yes.
But I point out, not as well in Japan. Value tends to work better in Japan, but that may change now because alpha sources are conditional on market dynamics too. And we can get into that, but
Yeah, I think is there another? Oh, you want me to talk? Okay. Sorry.
That's what they put
I
you
thought
up
I was
here.
being cut up
Yeah,
for.
yeah.
No, I mean, we do a lot of the similar sort of things, but the other side of it is, a lot of our research sources are boots on the ground. So analysts in Japan, there's, a team of analysts that we have in India, which covers some Japanese companies. We also utilize some of the data sources, and it's kind of how you utilize the data sources and what you're looking at. So sometimes momentum is in a good point. It's not necessarily the change, but it's the rate of change of the rate of change. So, that inflection point, those changes, are good signals in general. The other side to it, it seems like, the predictive factors with the data set, also adjusting the data when you can, if bringing it all to a common standard, standardizing data. This isn't just Japan as an issue, it's globally. So you want to make sure that, the way you handle depreciation amortization is the same way in Japan as in China as in the US, so you get apples to apples comparison. So there's a lot of data scrubbing and a lot of annoying sort of data issues that you need to deal with in order to really compare things cross country.
Hi, macro question on a MicroCap conference. Do you guys see investors' allocation criteria will continue to be focused on large or mega cap until the Fed rate change actually gets in place, or you see that is not a necessary condition to have more money flow in small and MicroCap? Thanks.
yeah, go ahead.
Sure. No.
Go ahead.
Yeah, I can take that. Obviously, this is my thought. So what I believe is that, and I was chatting with Doug about this yesterday, is that the rate hiking cycle, and this actually gets into the rate of change here too, is that the rate hiking cycle from 0 to 5+ was a very big headwind for small caps and micro caps. And the thinking is that these are, they're not globally diversified. They're more dependent on sources of financing. Their cost of capital has gone up. I mean, look no further than the REIT space. I mean, the REITs, even if you're a well-run REIT and you're collecting the same rent, your cost of funding just doubled. And that's a huge hit to earnings, and the multiple should correct for that. So that's why you've seen microcaps basically, I mean, the fact they're flat over the last 3 years in the face of that hiking cycle actually might be a victory. I think the good news is, and it was mentioned, that active management through that has done better, Signia included, because it's created a better, more hospitable environment. I think when you have rates anchored at 0 from a value shop, that's probably the worst case scenario when money is free. So I don't think we're going to go back there. Never say never. But to your question on the end of that rate hiking cycle being a catalyst, in theory it could be. I think if you look at how it's progressed, that we're not going to cut as aggressively as we thought. They said 7 cuts to start the year, or that's what the market was pricing. I didn't believe that. I don't think a lot of the market believed that to start with. But we might not even get a rate cut this year. But I think the reality is that we've all adjusted to this new normal, and that's what people should be focused on. And for our companies to work, I don't think it's going to have to be 25 or 50 bips necessarily. It might spark some algos or something like that, but if your company can absorb the rate regime right now, then you're in good shape. If they couldn't, then you're in trouble.
Just a quick question on how you view liquidity. I've noticed that liquidity has dried up quite a bit over the past decade. Is that an opportunity for you, or do you see that as a hindrance to what you guys are trying to do?
Well, I think it depends, right? It depends on what your source of alpha is. Like, for example, like a value strategy, maybe the payoff structure is years. You measure it in years. So from that perspective, you have quite a long time to trade, so you can kind of manage the cost that way. For us, we're a little bit faster twitch, so we have a little bit higher turnover because we think that's what's necessary to capture the momentum premium. And I think there's two forces, though, at play in microcap. I mean, I think we've seen the definition of microcap, at least from an institutional perspective, increase dramatically. So like in the Russell Microcap Index right now, there's a $5 billion company, and the weighted average is $1 billion. So what we've seen in microcap is actually the opposite. We've seen, because of that definition of microcap, we've seen liquidity increase over the years quite dramatically. So it depends on what part of the market that you're looking at. But yeah, no, liquidity is a huge potential cost that you have to be aware of, and we think, for us anyways, we have to make sure that we're transacting in a quote unquote liquid universe to capture the premium, because if you're spending too much, if the cost of your trading is then impeding your alpha proposition, that's a problem, obviously. So you have to cap your capacity as a manager to preserve that liquid universe.
I think also, I mean, over the last 20 years, I think buy-side trading desks have become way more sophisticated. So in mirroring sort of the alpha capture with the trading program, quite often in the past, they were separate desks. You know, as a PM, you just lob your trade over to the trading desk and go deal with it, right? And then you'd be like, why didn't you give me a good price? Mm-hmm. Now, the integration is way better than what it used to be. And there's also models that can be utilized. So like transaction cost models, there's off-the-shelf models, which we're not a big fans of, but there's ways of adjusting them to make it fit and address the microcap sort of liquidity challenge that you have. So, from our perspective, there's definitely, I think I know what you're saying, and I would almost argue maybe the universe has shrunk, and the advent of private equity getting in there, taking away good ideas. I think there's a lot of arguments behind that, but I think from a institutional class microcap investing, I think we've gotten more sophisticated as some of the liquidity is even reduced on the margin. So.
And I would say, just from our standpoint, running roughly 100 million, you can start to do some rough math around the liquidity that you need and the number of days that it would take you to implement. And it's pretty rare that we run into this circumstance where you've done work on a company and liquidity is the reason we're not going to buy it. So it's something we can screen for up front. So I would say for us, our loose rule would be, that trades 500,000 to $1 million in dollar value per day. That would be nice. Anything in excess of that, okay, that's better. You also need to be cognizant of too much liquidity in a name, perhaps, what that might signal, because I think sometimes lower liquid names, they have lower liquidity because they have a closer shareholder base. Maybe it's family owned. There's a lot of insider ownership, which I think, for by and large, if it's structured the right way, can be a good thing. So we kind of have a soft rule of 500,000, but if we really like the name and we're doing the work, then we'll continue with it. You just don't want to get into the worst case scenario where you own 1 million shares and it trades 10,000. Yeah. That's going to take forever to work out of, and the best case scenario, you're going to find a natural to transact with at a 10% discount, and that's not a spot you want to be in. So we definitely want to avoid that.
I know we've run up on time here. Just want to thank everyone on the panel. And I encourage everyone in the audience, if you have other questions, we'd love to speak with you after the presentation. So thank you.
Thank you.